Good afternoon. Welcome to the May 17th virtual roundtable. Today we are hosting Tom Shaner and Cynthia Adrian from the Idaho Tax Commission. They will be going over the recent federal and state tax reform and what that means for Idaho and its taxpayers. If you have any questions, type them in as they come up, and we will make sure to get to them as they come up or relevant or towards the end. And with that, I will hand things over to Tom to get started.
Thank you. Yeah, my name's Tom Shaner. I'm the tax policy manager for the State Tax Commission. And last legislative season was a little bit crazier than average, so we're getting lots of questions. If anybody follows legislation, it was extremely unusual for us. We typically conform to the Internal Revenue Code every January 1st, and the language we use includes all the edits and updates and changes up through the day before. So we use the law that's in effect on January 1st, which is a holiday anyway. This year, because last fall, we started tracking the tax reform as it was working its way through the Senate and the House, and we had planned to use December 31st to avoid the new tax law, thinking that they would certainly only affect 2018. And then they signed it on December 22nd. So we quickly edited our statute to conform as of December 21st. And that is not a typo. It's December 21st. We intentionally wanted to avoid the federal tax reform. We ran two bills this year to adopt the 2017 conformity so that the filing season could get underway. And then in a separate bill, conform to the federal tax reform. And when I say we, the Tax Commission doesn't decide what to conform to. That's completely up to the legislature. So we can suggest things and answer questions. The legislature makes all the decisions. We didn't want to hold up the 2017 filing season while they potentially argued about all the bigger issues in 2018. When it was all over with, they really didn't get too bogged down even with that, but it was safer to separate the 2 years. The one thing we did for 2017 was there were two issues in the tax reform that reached back into 2017, and those were lowering the threshold to claim medical expenses on Schedule A and repatriating foreign, previously unreported income of foreign subsidiaries. So our 2017 bill says we conform as of December 21st, except these other two statutes, 965 and 213, I think is the medical. That would allow everybody to file their 2017 tax bills. The state conformity, tax reform is really in the 2018 conformity, and that's where the legislature created the Idaho Child Tax Credit to somewhat offset the loss of the personal exemptions, and lowered all the tax rates. So that's really the Idaho tax reform. We conform to the vast majority of all the federal stuff, and it's surprisingly simple as far as preparing your Idaho returns. I've gotten a lot of questions about, oh, you guys adopted some code section or whatever. If it's already in your federal adjusted gross income, unless we specifically call it out, then you don't need to do anything on your Idaho return. And I'd say that's probably true of 90% of what was the new tax law. So that's kind of an overview of the craziness that went on. We ended up with 4 conformity bills, those 2 major ones I talked about, and then they increased the child tax credit to $205. And just for fun, Congress went in February and extended a bunch of laws that sunsetted December 31st of 2016, and they made them retroactively alive to the year of 2017. So we had to conform to that because we had missed it with our other 2 conformity bills. With that, I will turn things over to Cynthia to talk a little bit about the individual returns, and then I'll go over some of the business and corporate stuff. So.
Well, good afternoon. I'm Cynthia Adrian. I'm a tax policy specialist with the Idaho State Tax Commission, and I will be telling you a little bit more about the individual stuff that happened this year. So as Tom said, one of the provisions of the Tax Cuts and Jobs Act was that they went back and made some things retroactively active. So that medical provision that you always had on your Schedule A, and it said, oh, you can only do it up to 10% of your adjusted gross income, it became 7.5%, and that was retroactive. So we had already done our forms, of course, for 2017. So we had to put something on our website that said, oh, our instructions are wrong. You can now take, instead of 10%, it's 7.5% of your adjusted gross income. So that was one of the fun things for the individuals. And then when we conformed to tax reform for 2018, of course, that changed the standard deduction federally. Well, and we conformed to that. So standard deductions are now $12,000 for singles, $18,000 for head of household, and $24,000 for married filing jointly. So it eliminated personal exemption. So that $4,050 or whatever it was that you used to get for each one of your dependents, you no longer get. So that's why the Idaho legislature went in and said, okay, wait a minute. All of our big families in Idaho are losing $4,000 per person. What are we going to do? So that's when they decided to do the Idaho child tax credit. It started out again as, I think it was $130. And then later in the legislative session, they decided that wasn't quite enough to make up the disparity that caused. So it was changed to $205. They capped or eliminated most itemized deductions. The feds did. So that's something else we conform to. So there are a lot of people now who may not itemize. We kind of looked at it at the Tax Commission and went, okay, how many people itemize now? And given the new standard deductions, there's some people that are just going to fall off and not be able to itemize. The standard deduction is going to be a lot more than what their itemized would be. So I know that there are some charitable organizations that were concerned that people are now not going to be able to itemize, so are they going to even still give their charitable contributions because they're not going to be able to itemize those? So there are some concerns there as well. And Idaho then went ahead and said, okay, along with the child tax credit, let's lower the tax bracket. Let's lower the rate. So they've lowered them by 0.475%. So instead of the highest one being 7.4%, it's now 6.925%. So that's another way to kind of help out those people. When that happened, that changes our withholding table. So we're still in the process. I had a meeting earlier today about withholding and how we are going to, we've got new tables out but we're trying to get as much information as we can out to employees as to how to fill out their W-4, and everybody should go out and look at your W-4 because it's going to change not only federally but for Idaho. Federally, they have a withholding calculator to go out and look, and you can put information in, and it's going to tell you exactly how many to withhold. For Idaho, we don't have that as of yet. We're going to have worksheets, it looks like, at this point. So, but that should be able to guide you through. And we want you on the W-4 to put not only a federal number, but an Idaho number. And they're going to be different because Idaho's going to only take into consideration your children that would qualify for the Idaho Child Tax Credit. Or there could be other things, but generally it's those children that you're going to look at. So, and anybody for the Idaho Child Tax Credit has to be younger than 17 as of December 31st of 18. So if you have a child who's over 17, you're not going to get the child tax credit for them. Let me see, what else has happened? The 529 education account, that is now, so it used to only be for higher education. The feds made it now include K through 12 and private schools. That is a big deal.
Yeah. Wow.
And Idaho adopted that.
Wow.
As well. So that is something that we actually have met with the Idaho College Savings, the IDEAL people, and they actually ran some legislation. But yeah, it's that is a huge deal because now you're going to be able to use that money for, you know, your children who are in private school or, you know, whatever. So that was a biggie. I can't think, Tom, can you think of anything else I've missed? That was the major things that I could think of.
No.
I've been kind of engrossed with the W-4 stuff the last and the withholding tables. I'm usually not working on Friday, and I'm coming in tomorrow because we actually put tables out. The chairman wanted us to get our tables out sooner rather than later because the feds actually had theirs out in like February. And so he's like, you know, we need to get these out. And we were like, oh, well, we can't until the legislature's gone. Well, once sine die hit, he's like, okay, we'll have these out by the end of April, right? It's like, okay. So we were working feverishly to do that and got some out. And now we've had some feedback from some people and went, maybe this is not the best way to do this. So we're kind of rethinking this and pulling some things back. So I've been engrossed in that as well as forms. So forms are part of my life right now, and they're a little challenging this year because now those personal exemptions are gone off of the form and trying to figure out how that all works. And then we got to have a space for that Idaho Child Tax Credit now. So where does that one go? And so yeah, it's been a fun time, but that's all I can really think of for individual stuff. So I'll turn it back to Tom and let him talk about all this business stuff.
Yeah. And the way we have things categorized on this handout between individuals and business is a little bit arbitrary because although the items that are listed under business would be business related, they can show up on an individual's return if you're in an S corporation, partnership, and that kind of stuff, or a sole proprietor. So that's why we use the term business instead of corporate, as they could be on either type of return. Just a comment on the W-4s. There used to be kind of a correlation between the federal and the state because we use the same exemptions they did. With the federal now, they have the $2,000 refund or non-refundable child tax credit and the $1,400 refundable. Ours is $205 non-refundable. So with that much of a difference, if you go through the federal worksheet and figure out how many allowances you should have, you don't want to use that on Idaho. You'll end up with a strange answer. So, on the business stuff, we did adopt several of the extenders, and these are, if anybody watches tax law, I don't know why you would if you don't have to. These have been renewed annually, basically, some of them for up to almost 20 years. And every year Congress lets them expire, and then they come in and renew them. And it's kind of a joke, but what they did differently this year was they waited an entire calendar year. They went in February of 18 and renewed things from the end of 2016 through 17. Normally they would do it in February of 17 and kick them forward. So we did kind of a scramble to go in, and we did not extend all of the things the feds did because they had a lot of credits and things that we don't use. So we tried to get the important deductions, and those are listed on, what's that, page 2. They might seem a little obscure, but they're important to the people that can use them. So we tried to get those in there. Yeah.
Okay.
That's House Bill 624.
Okay.
And because Idaho does what is called conforming as of a date certain, there's only 7 states that do that. Other states will use the federal taxable income as their starting point, but they'll do it either on a rolling basis, and their legislatures will just opt out of things that they don't like. There's a short list of states that just pick a specific date. So anything that Congress does after those dates, we don't adopt until we go back and ask them to look at it again. They have to proactively adopt the federal tax law each time. We were told it's unconstitutional under Idaho to kind of secede their legislative authority to the Congress and let them make those decisions. So that's why we go through this every year, and we try to get our conformity bill in one of the first things that they do, so everybody can file their tax returns. And most years they help us out with that. The real business specific things are on the last page, and things like Section 179, where you can automatically expense things that are depreciable. They raised the limit from 500,000 to $1 million. They also raised the bonus depreciation. That is one thing that Idaho doesn't conform to. They've opted in and out of that over the years. There were a couple of years where they conformed to it, 9 and 10, I think, 8, 9, something like that.
Yeah, 9 and 10, I think.
We looked at that, but the fiscal estimate on what it would take to conform to that was more than they wanted to absorb. So businesses, and this would include a sole proprietor, so somebody's got a Schedule C business working out of their house all the way up to the multinationals. Well, there is a phase-out upper limit on what you can depreciate. I think if your top depreciation, so you're putting more than, it used to be 2 million. I think they raised that to 5. Anyway, they raised the upper limit, so you lose the ability to do that immediate expensing if you are purchasing too many assets. Simplified accounting. There's a long-standing rule under the Internal Revenue Code that if your gross receipts are more than $5 million, you have to use an accrual system. So one of the simple example of that I use is you get towards the end of the year and you're making money, you're going to owe some tax. So if you're on accrual, you go buy some inventory. Well, you can't expense that immediately. A cash basis taxpayer can just use that as a deduction and then go count it whenever they sell it. For accrual, you have to put it in an inventory, and you can't use it as an expense until you sell it, and then it's a cost of goods sold. So they raised that threshold from $5 million to $25 million. So that'll pull in a lot of, $25 million is pretty good. I'd like to have a $25 million business. It's a decent size. Wouldn't be working. So we adopted that. Some of these are, I don't know, kind of in the taxpayer's favor and some are not. The next one, interest expense is limited to 30%. So if 30% of their operating income. And I think that part of the idea there was they didn't want to fund more or less investing. So if you have a company, and especially with overseas stuff, they didn't want a company borrowing a bunch of money to go and invest in other companies or stocks or whatever and be able to take a tax write-off while they're making money with the investment. So they said anything over 30%, up to 30% seems kind of reasonable just to do your ordinary operations. If you're borrowing enough that your interest is more than that, then they just make you carry that forward. We did adopt that. We need to make a little correction to our statute, but if you hit that limit, then you would be able to carry that excess forward for both federal and state. 1031 exchanges or tax-deferred exchanges. So historically, if you traded any like-kind property for other similar property and you didn't get any cash back, then you didn't have to pay tax on that until you sold the new one. And that was used for real estate, artwork, antiques, airplanes, all kinds of things. They've limited that now to just real estate. I don't know where they got that idea. Some of the S Corp to C Corp conversions. An S corporation is where the income and expense flows directly to the owner's tax returns. And there's parameters for that. You can have up to 100 owners. And only certain types of entities are allowed to be owners. C corporations have, the corporation itself can pay tax or will pay tax if they owe any money. So there's some rules when you convert back and forth from one type to the other. They don't want you to gain any benefit by making that change. They've relaxed those rules a little bit, so they allow some adjustments after the conversion to help save on taxes. Of income, this is when businesses are required to report income on. There's always a difference between book income and tax income. So book income will be for your financial statements, and if you're publicly traded, that's under the SEC rules. But otherwise, it's people that do financial statements for the banks and creditors mostly. And then when they do their tax return, they have tax-specific rules. So there's generally differences. They relax that a little bit, but you have to report your taxable income no later than when it's included on your financial statement. So you can't go show the bank how wonderful you're doing and then show the IRS how bad you're doing. Kind of a tradition. We repealed Section 199, and all of these things were effective January 1st of 18. Just made that clear. This was the domestic production deduction. It's a bizarre calculation, partly based on wages and investment, but it was a pretty good deduction for any size companies, from a little mom and pop all the way up to huge corporations. That's going away, and it's being replaced with some of these other things. They repealed the employee entertainment expense, so companies can't write off company parties as much as they used to. Recreational memberships aren't allowed, so the golf club and professional memberships are still allowed. So CPA Society is one I belong to. What else? Transportation and parking reimbursement is no longer allowed. That's not deductible for the company, and it will be taxable. I think that's probably more of an issue in bigger cities, where New York and Chicago, where you have to lease your parking space by the month. But employee commuting and parking allowances are no longer deductible, and if they're paid, they will be taxable to the employee. And that includes moving expense. If a company, as part of a recruitment package, paid to move a newly hired person, and sometimes they'll help them buy a house and help them sell their old house. So a lot of those things are going away. The next one is Section 199 Cap A. Now, this was different than the Section 199 up at number 7. There's really no relationship to it. It's just a coincidence. But this allows, and on the federal side, they were trying to balance the difference between the C corporation tax rates, because they just lowered those from 35% down to 21%. And people said, what about partnerships and S-corps? So they lowered that by giving them a 20% expense. It doesn't quite balance it. It's not exactly as low. But on the state side, our top tax rates are the same. And so it really is just kind of a windfall for any pass-through business owner, which includes S corporations, partnerships, and sole proprietors. So anybody that has the Schedule C gets a 20% expense on their federal return. This is a good example. I've gotten several questions about, okay, Idaho's adopting this. What form do we fill out? What's the calculation? This is all done on your federal return. And so it's done on a federal individual owner's return. Up to, I think it's 350,000, you just get a straight 20%. If you get over that, there's a range where there's a formula. They limit it by your property and a certain percentage of your property and payroll. And there are certain categories of professions that are treated differently than others. But if you make less than 350,000, you just get a free 20% expense. That's on your individual federal 1040. The answer from that form comes over to your Idaho return. There's nothing more to do about it. You don't add anything back. You don't subtract anything. So really, the majority of these are in that category, I would say, where because we adopted it, there's nothing left to do. It's simply the feds gave it to you, and we're going to let you keep it. So the last one is if there's pass-through losses, so this would be as corporations or partnerships, in excess of $500,000 for joint filers or $250,000 for single head of household, that kind of thing. If you exceed that much of a loss, and you have to combine your investments, so if you're an owner in 2 or 3 S corporations and partnerships, you pull those together and look at the total losses. If you exceed those thresholds, you're limited to that amount as a current loss, and then you have to carry it forward. So we've also adopted that, and I thought, well, you know, if somebody's losing that much money, there's probably not that many. So I asked, we have a guy that does our data statistics, and I asked him if he could run some reports on that. I was expecting to get maybe a couple dozen or something in the state, because, you know, you're losing $500,000. There were hundreds of them. So, and I realized though, some of them that we looked at, you could have a loss of $500,000 from an investment like that, but if the taxpayers have $1 million salary, you know, they may still owe some tax. So, and then there's limits between, you know, if they're passive losses, you can't offset active wages anyway. So that's kind of the end of our tax reform. The big state reform is reducing the tax rates and the child tax credits. So that's kind of.
Do you mind if we share this worksheet if anyone asks for it?
Oh no, this is
you
public.
Have it on your website, and then we have
we're handing it out.
Yeah. Okay, so then do you recommend everyone go through their W-4?
I would.
Okay.
I would, just because things have changed so much.
Yeah.
And you might want to make sure, you know, I was going to say do it now, but wait until we get our information out for Idaho. Because like I said, that number you're going to put for Idaho, so on your W-4, there's a line 5 that says how many allowances do you have? And we're going to want you to put a federal number, but then we want you to put a slash and put an Idaho number, because those numbers are going to be different. Like Tom said, if you go through, I don't know if any of you guys have been out to the IRS's website, they have a calculator. And so I went out a couple of weeks ago and I went, okay, so, you know, it's going to ask you your filing status and things you know right off the top of your head. But then it says, okay, what was your itemized deductions from last year? If you itemized, how much were those? And how much were certain things on certain lines? And then it asks you, so your last paycheck, how much was withheld, and when was your last paycheck? Those kind of things. Mm-hmm. And if you have a spouse, it's going to ask you for the same information. And then it actually comes up and it tells you, according to the amount that you've already had withheld, here's what your withholding allowance should be for federal. And if you need to have more withheld, here's how much more you should withhold and how much more your husband should have withheld. Just based on how much you make and those kind of things. So I'm going to have to change my W-4.
Oh, really?
My W-4 needs to be changed. And then for Idaho, it's going to be, like I said, for most people, it's how many children under the age of 17 do you have? Mm-hmm. My husband and I have 0 under the age of 17 at this moment. But we have a couple of other worksheets that we're working on, and one of them is deductions. So if you have itemized deductions, you may need to increase or decrease your allowances depending upon what that number is. Also, since my husband and I both work, we may need to change that number, or you may need to change it if you have, so say you're single and you have 2 jobs. You might need to change it because of that. So there are going to be those worksheets to go through, and I would suggest that everybody go do that.
So when will people start seeing these changes on their paychecks?
Well,
the federal tax rates have already taken effect.
Yeah.
Okay.
So you've already seen it on federal, and the Comptroller's Office was going to implement them with the June 1st, I think, kind of paycheck, that time period. I don't know if they're still going to do that with us making a few tweaks now, but I would say sooner rather than later. We wanted to get the information out so they had it.
Our by the nature of it is a lot more two-dimensional than the federal, because you do all those calculations on your federal return. That's where the itemized deductions are and all that kind of stuff. So when you get over to Idaho, it's mostly what's your taxable income. And we're adjusting from the federal answer all the time. So, but the disparity has grown quite a bit with the difference in the child tax credits.
Exactly. So if you go out and do that federal calculator, or if you go look at their worksheets that are attached to their W-4, it says if your income is between here and here, you know, take the number of dependents you have or whatever and multiply it by 4 or something. Or it's like, what? You could end up with like 12 people, you know? It's like, no, you don't want to use 12 for Idaho.
No.
That's not going to be a good thing.
Right.
Yeah, I would highly encourage everybody to go out and look at that. You could have either be under withheld or over withheld. Over withheld just means you're going to get a bigger refund. So it's like, okay, maybe you'd rather have more money in your paycheck every week than get a whole big refund at the end of the year. Or the really bad thing is you could be under withheld.
And you have to pay, right?
Under withheld means you're going to write a check. And nobody likes to do that in April. So, yeah, I would suggest that.
And if you do adjust your W-4, you got to do both the federal and state. You used to be able to just use the same answer. It doesn't work anymore.
And if you do change it, then come January of 19, you need to look at it again.
Yeah.
So not just once when you first get your job and
yeah,
never again.
Exactly. That's really what's happened to me. I've been at the tax commission for 10 years, and so when I started doing all this, I went out to the controller's office and looked at my pay stub, and I was like, really? My withholding allowances was 3. And I was like, oh yeah, when I started work, both of the boys were still home. So I put 3 on there, you know, so it's like, oh, maybe I better go check this out now. So yeah, it's a good thing to go do.
I don't see any questions from our audience.
I have a question. Do the surrounding states do conformity as well, or do they do?
Well, there are some states, of course, around us, as you know, that don't have a tax.
Mm-hmm.
So Washington doesn't have an individual income tax. Neither does Nevada. Neither does Wyoming.
Okay.
So those are 3 states that don't do anything because they don't have one.
Mm.
Oregon conforms,
Mm-hmm.
but they have quite a few differences. So,
And I'm not sure about Montana and Colorado and
Montana uses
Utah.
federal taxable income. So does Utah and California.
Yeah.
So when it comes to Oregon, we can say that our conformity maybe gives us a little bit of a bump over.
Yeah, if you look at income tax in isolation, but we publish a tax burden study every year. Alan Dornfest publishes, I should say. I don't want to take the credit for his work. That shows the collective burden of sales tax, property tax, and income tax for the typical Idahoan. That's a little better comparison. Like Washington doesn't have an income tax, but their property tax and their sales tax are both significantly higher. They also legalize marijuana and they have other revenue sources.
Yeah.
Several states around us have done that, and so to look at the income tax in isolation is misleading.
I wish every politician from the local level all the way up to state would read that annual report.
Yeah.
It's frustrating to the politician. We're delivering one message to our clients, and our politicians are delivering a different message. And so if we all just went with the report and delivered the same message, I think that would make our jobs a lot easier.
Oh.
Well, and I think one of the things the politicians point out always is that until now, our tax rate was higher than most people around us. So that's one of the reasons I think they wanted to get it below 7%, is to kind of make it more competitive with surrounding states.
And it does, with the growth, they can lower the rate and have more people paying in with sales tax and that sort of thing, and end up with more money.
Mm-hmm.
It works for a while. There is some point in diminishing return. We'll find out what that is.
Yeah.
Okay, well, no questions. Thank you, guys. Do you have anything else to add, or does anyone else in here have any other questions for you? Okay. Just to remind everyone, this handout is available at the Tax Commission website, correct?
No.
It should be under tax reform.
Okay.
We have a tax reform icon on our website, so I think if you click there, it should be there.
Okay. And if you can't find it there, we can certainly give it to you there from
We can send it out. We were on the website at piecemeal. We wanted to put 2017 out there first and not all of it. So if somebody's trying to do their last year's tax return, and didn't want to confuse them. We have been handing this out to CPAs, legislators, tax preparers, and others. So it's all public. And
okay. All right. Well, this information is available for you guys. So with that, if you have any other questions,
just,
go ahead.
I would say we're available for questions. So if you think of anything next week or next month, feel free to get a hold of us.
Okay. We can do that if you email any one of us here at Commerce, or Tom Shaner or Cynthia Adrian at the Idaho Tax Commission. We can get your questions answered. So, thank you.